Hello, welcome everyone. So this is the Mayo Clinic Business Accelerator. For those who haven't been here, we opened March last year. We have 15 startups who call that their home. We have 4 VCs that have offices here. This was a joint effort from Mayo Clinic, particularly Treasury Services and Mayo Clinic Ventures, Ready, Rochester Area Economic Development, and the City of Rochester. What we have here, for those who don't know, is basically we offer a place for businesses to start. We have workstations which we move. The workstations go for $100 a month. We have offices, we have 6 of them. They now go for $500 a month. We're trying to change that to a part-time model. So there might be opportunities if you are thinking about starting a company. We encourage you to talk to me. I have business card there, or you can find me after the event, and I'll tell you more about it. We offer free Wi-Fi, a place for you to start. This turnkey operation on a month-to-month lease, designed to be low cost of entry. Tonight, we've been organizing this after evening events with some of our partners. Icon Venture Partners is one of the tenants here in the accelerator. They come quite often, and they've graciously given their time. Tonight, we're going to talk about how to build a business pitch. And just to say something more about Icon, they have a partnership with Mayo Clinic Treasury Services, and they're currently exploring startup opportunities with Mayo Clinic Ventures. So they've been a great partner for us. They've done, I think, 3 events so far. They met this afternoon with some of the people that wanted to start companies, and that's had a really good feel to it. And we have more people than we could accommodate, but hopefully we'll do it again. I won't introduce them. I think they said they have a slide for a bio on each of them. So without further ado, please help me welcoming Icon Venture Partners.
Thank you, everyone. I really appreciate it. We'll keep to ourselves in just a second, so we'll go through an introduction. We'll talk about the elements that should belong in a pitch to venture capitalists. Talk about some additional considerations around the pitch, and then we're going to leave quite a bit of time for Q&A at the end, because that's usually more informative than just a discussion. And if there's anything that comes up along the way, by all means, you can interrupt us and we can answer something on the fly as well. So that's us. I'll let Charles introduce himself first.
So it's looks, brains, and brawn is how we have it set up. So my name's Charles Beeler, for those of you who haven't been at some of the prior events. So thank you first for coming. Really appreciate you're all taking the time. Hopefully you get something from the session. Look forward to meeting some of you afterwards. So my story started here, actually up on Pill Hill, which is, well, at St. Mary's originally, I guess, but then Pill Hill. My family's been involved with Mayo actually since the 30s. My father was in the information systems group for a number of years. They still live here in town. So it was great to have an opportunity to work with Mayo and come back and spend time here in Rochester. I've been in the venture capital business for about 15, 16 years now, always focused on early stage enterprise technology, which is really what Icon's core focus has been. I've been based out in the Bay Area for just over 14 years now. Jeff and I started Icon just about a year and a half ago, closed the fund March of last year and started investing out of that. And we'll talk a bit about that later on, but really looking at the types of deals we're looking at here. And so most of my career has really been spent in venture. Prior to that, I got a chance to work in systems and procedures for a little while, and they didn't fire me, which was appreciated. And it's always great to be back here, frankly, because I think this room shows it. A huge opportunity in Rochester, a lot of interest in startups and opportunities to work with startups. Mayo's just done an amazing job in the time we've been working with Mayo in encouraging this. So the turnout here is just really, frankly, really fun to see.
And I'm Jeff Hinck, also with Charles, been a venture capitalist for 17 years. Before we actually started Icon together, we worked on a number of companies together. He was one of the few people who would actually come back to Minneapolis from the West Coast and work on Minneapolis deals with me, which
or drive in a snowstorm from
driving in snowstorms like this morning to get down here. But and I'm in Minneapolis and have been my entire venture career. So I've got selfish reasons for wanting more in Minneapolis as well too. It keeps me from getting on planes all over the place. And then
I'm Michael Kline. I am also a native of Rochester. Go Spartans. I grew up here, and my dad actually worked for Mayo. He was a research scientist in the microbiology department, and my brother actually works upstairs in Mayo Ventures as well. I am what they term the brawn. I do a lot of the work on the ground. I do a lot of diligence when we look at deals. I go into companies, I take interim roles within companies, primarily kind of the CFO or a VP of business development. Do a lot of strategy work with portfolio companies, as well as I'll sell them on the back end. Before working in venture, I was in investment banking and worked with tech companies and media companies, both old and new companies, old and new media.
Right, so that's us. Wow, just gotta man the film. All right, so the elements of a pitch. Hopefully some of that come out in the back. But starting with the introduction, you want a short, impactful statement right out of the gate that lets people know what you do. I mean, a lot of times you'd be surprised. We can be somebody can be at 30 minutes into a pitch, and I'm still, I don't even know what you make, right? And it's kind of compensated. So on each of these slides, we're trying to give little bits of examples of things or talk about a little bit more. So these were just 2 examples of companies we funded, and literally what was on the first page of their presentation on what they did. So again, just something short and simple, so I can say, okay, now as we go through the rest of it, I at least have some mental grasp of what you're doing.
Yeah, and so when you present to a venture capital firm, typically the first meeting, you have an hour, you get a chance to go in and talk about what you're doing. It's not if it's a good meeting and they want to meet more, it's not going to be the last time we spend time with you. So the real goal is to get the key parts of your story across. But at Jeff's point, yeah, you have an hour-long meeting. You got about 5 or 10 minutes to really show someone that you understand what you're doing. You can tell the story in a clear and succinct way. Because if you can't do that in a venture pitch, the odds of you doing that with a customer or when you're marketing the organization aren't any higher. And so we're always looking for, do you understand how to codify this down into a simple statement, here's what I do. If we get that, it's sort of that first hurdle, and you get to kind of move on from there. So this is a really important thing to think through. And again, we thought some of these were some of the good quotes, but most of the ones we funded ended up having something like that.
So the next part, in any pitch is the team. And it's really, somewhat like we did with ours, and we'll show you one again from a company that we funded recently to give you some example of it. Short bio on the founders and management. I mean, sometimes that, often that's one and the same. It might just be one person. And really what we're kind of looking for is what's the domain expertise? Why do you know something about the area you're talking about, right? Are you in an area where, you have some credibility, or is this, kind of, a fanciful thing that maybe you don't know anything about? Obviously, we're looking for the domain expertise. And the team certainly doesn't need to be complete. We're just looking for, a nucleus that we can build things around, somebody that's there that, we can create the rest of the team. Because we're early stage investors, we probably didn't mention that in the beginning. So, I mean, a lot of the things we're investing in, they don't have products. It's pre-revenue, pre-product, 2 people and a barking dog or something like that. So it doesn't need to be complete. And we think one of the mistakes a lot of entrepreneurs make, especially because most technology companies are started by technologists, is, I better get a business person, and they'll show up with somebody that's completely wrong for that role, and then we're having a double problem because now we have to get rid of the person that they brought in. So not looking for a complete team, but they're looking for a good core nucleus.
Yeah, and if you go to the next slide, if you would, Jeff. So this is a company that we actually funded just a couple weeks ago called Cubo. It's a seed stage company, but it's a seed stage company that actually has customers and revenue. Some of the customers listed up top. The thing I liked about this team slide and why we chose it as an example is Victoria, who's the CEO, has been a CEO. She started a company that's doing $20+ million in revenue. And if you read what they talk about, understanding what to do in terms of continuous innovation, what they're really doing is providing technology for enterprises to more easily take existing applications and essentially webify them, improve the agility in terms of the ability of how quickly can you make changes to that, can you get to 2-week code releases as opposed to 6-month releases. And if you look at their prior businesses, they literally have done the exact same thing in different instantiations during their careers. Stan, as the CTO, has managed large teams. In fact, prior to this, he'd managed about half of the existing engineers that work for the company. They're actually all based overseas, and so he knew the team already. And then Avery, who's the chairman, but he's an active chairman. Avery is kind of the pure business strategy brains. And again, given his background at both at McKinsey and IBM, his knowledge and his understanding of working with the team, because he's known them a long time, it really typifies, this is it, that's the entire team. They have an engineering group overseas, but this is everybody on the company today doing close to $1 million in revenue. We've got a lot of work to do to build this team, and we knew that coming in, but this is, to Jeff's point, the kind of nucleus that we look to start with.
So the next part is around the opportunity and the problem. And the first is kind of the what, why, and when. What's the opportunity? Why is this a particularly painful thing, or why is this a great opportunity? And when, which is also very important, because a lot of things are way too early to market. Like we are going to do X, and all that we need to for that to happen is these 12 things in the universe that won't possibly happen for 20 years. So it's also important to, why is this timely now, not yesterday or tomorrow, but really answering those. And then what's the degree of the opportunity, or the intensity of the pain? I mean, is this something that when we talk to customers or prospects, is it going to be, wow, I'm dying without, and if I got this, my life would be so much better? Is it like, well, I've got 10 priorities this year, and that would probably be 10 more down from that, right? So we're really looking for something that needs to be solved now, urgency, or something that's a really truly big opportunity. And then also we think often good in the pitch is some customer or prospect testimonials, right? It's always good because we're going to be calling those people if we get to diligence anyhow, right? So it's good to have some people that are prospects, customers, to talk about why it's important to them or what they see in it that's particularly intriguing. Again, it just helps kind of give credibility to the to the whole pitch.
Yeah, we like seeing customer logos in early stage companies. It's a good sign that you've gone out, you actually haven't thought about this in a box, you've gone out and talked to customers, gotten feedback, and even if they're not an existing customer, they're happy enough about what you're doing, they're willing to talk about it. It says a lot about the research you've done to really make sure these first 2 points are being addressed.
The next, your secret sauce. What's the product, or the solution to that, right? And again, it's kind of, what is the product, specifically? Is this, software, hardware device? Again, like, why is this, important? Why is this good at solving the problem, right? If the problem was, networks are too slow, well, then this should be, a fast way to make networks faster, right? Those two line up. You'd be surprised how often pitches, don't really have much congruence in them, right? Here's a big problem, and what I just talked about in the product doesn't really solve it that well. Again, when's it going to get done? How much effort is it going to take to finish this product, right? Is this something that's, it's done already, you've got an early prototype, or, it's out in the market, or we're, 2 years away. So, in getting at that, and how much of, money and development effort is that going to take, so we can kind of quantify, again, how much money is it going to take to get to that product. It helps us, estimate, the risk level, et cetera. Like I kind of alluded to before, make sure you solve the problem identified. It seems really simple, but sometimes people don't do a good job of conveying that second one there. And then the secret sauce and differentiation. Why is this really important? Why does this differentiation matter? Right? A lot of times people will spend 20 minutes talking to us about how this product is so much faster than other one out there, or something like that, and you really get to, does anybody care? Well, no, it turns out 2 people, care about speed, everybody else cares about ease of use. So make sure that it's differentiated, number one, but that differentiation actually matters to the problem at hand, right? Charles.
Yeah, and so on this, I'd say kind of going back, starting with team, right? So we want to meet, doesn't need to be a full team, but it needs to be a team that understands the market they're going after. And so you start to get into define that market, define what the need is for me. This is where the rubber starts to hit the road. So you're partway through your pitch here, and we're assuming at this point, you understand what you're talking about, you know the market. So it's always interesting when you get to this part of the presentation and it falls flat. You're thinking, wait a minute, this is a person who knows the market, they understand the customer's needs, but they're not able to really in a clear way outline, here's what I'm trying to do, and here's why it matters, and here's specific examples. So it's in the middle of the deck. If you think about that hour-long flow, right, you started out with a great quick, here's what we do, we got excited, your backgrounds are great because you started Google and Facebook and everything else, and we want to back you. And then you get into the sort of fat middle of the hour, and if you fall flat here, it's really hard to pick back up, because if you can't explain this, when you get to the next thing, which is market and the opportunity, it's really hard to believe that you know, really to the degree we need you to, what you're talking about. So spend time on this and practice it and test it with yourself, test it with potential customers, and test it with just people you know who can say, yeah, I get all that, but how does it tie back to what you just told me about the market? I think it's an area where people spend too little time. They want to spend more time showing us the details of their technology. That's great. We're more interested in that first meeting and understanding these higher level bits.
Yeah, and so one other thing on the previous slide, you talked about the pain points, right? Why is this a problem in the market? And we talked about your secret sauce and your differentiation. It's why you solve that problem uniquely different than the other competitors in the space. And you'd be surprised at how many people can't really clearly articulate that. And when you're a startup and you're selling to investors, we're wondering, you know, why would the Mayo Clinic buy from a startup versus a reputable vendor in the marketplace, right? And to be able to clearly articulate that to the investors, help the investors understand why you'll be able to sit down in front of the customer and sell the customer, and the customer will actually buy from you instead of going to that large vendor.
So, Jeff, one more thing on differentiation too. Differentiation has two pieces. One is, how are you different today? But as a startup, you want to run this thing for 5 to 7 years and get an exit. Explain how you're going to be different in 5 to 7 years. What is it that you're doing today that potentially makes you even more differentiated down the road? We've been spending time with some of the folks at Mayo on a project that I think frankly has that same potential. It's differentiated today, but what they're actually doing is something that will make them even more differentiated 4 or 5 years from now, make it much harder for a competitor to come along and copy what they're doing.
And then I think within that, just a final point is also what are the metrics that are important in this, given industry, or this particular, buyer, right? And then how do you kind of quantify that, right? So, for instance, yesterday I was visiting with a company that, automates accounts receivable and the questions for that, and their claim was, this is painful, it takes people a long time, we're going to make it faster. And so it's, well, what is the average, before you get there, what is it afterwards, and what does that mean for the typical customer, right? I mean, how much are they saving? How much do you change that cash conversion cycle? So, again, kind of metricating, that differentiation, and, especially through the, potential customer's eyes, right? What are those numbers? And then the market, size and segmentation, to whom does it really matter, and how many of them, really exist out there. So again, it's, well, we're going to serve everybody. Well, probably not, right? We start cutting back, again, who are the ones that really have this particular pain, most acutely, what size is that market, right? Where are you going to go after first? And really trying to kind of segment it. And these were just, kind of an example down there, market segmentation. There's these 5 categories. This is the first one I'm going after, which, may be, reasonably small. Eventually there's a big market, but really trying to understand what's the tip of the spear there. And we are looking, for big markets, certainly ultimately, hopefully to begin with, but it's fine if the first one is a little bit more of a niche because maybe it's an evolving product, problem. 10% of the market has this problem today. We think tomorrow it's going to be, 90%, so we're going to start with the 10. Well, that certainly makes sense. Who are the competitors? What are the substitutes? So people are doing things today. What are they doing? What are the various choices in there for people? And then I kind of threw up the, Michael Porter analysis. And obviously there's more words there than you need to read. But, really, what are the competitive dynamics here? What is the industry, you're selling into? How many buyers are there? How many competitors are there? What is the dynamic there? And I think that's something that's often overlooked in venture for the technology prowess or something. But what does that market really look like, right? You have an awful lot of startups getting started to sell to utilities, only to find out, well, utilities are kind of a crappy customer segment to sell into, right? They don't buy a lot. There's not that many of them. So that's obviously a very important one too. And one point I think we'll have it later on the other considerations, but when we really think about the whole presentation, I mean, initial presentation should be like 12 to 15 pages, and a lot of people will come with a 50-page deck. We've got an hour, right? We're trying to get to know each other, go through the salient points. So it's, it's kind of a page for the intro, there's a page for the team, and then there's a couple, for each of the next ones, right? So it's really a pretty short document. Again, getting it concise, focus on a few key points, because if it's something that we or another venture firm like, we're going to have multiple meetings to dig deeper, so you don't have to go all the way down, day one. And you don't know which, I might like to get into technology, whereas Charles might really like to focus on the market. So at the beginning, you just want to make sure you cover, a high level on all the important bases.
Yeah, and on that one thing, Jeff's final point, one thing to think about. So you always have more that you want to talk about than you're going to have time for, and so you have to decide what are the key things I want to cover. There's no harm in having a bunch of backup slides you have no intention of showing. So if someone says, I just want to dive in, what's the market, and they're not happy with what you've shown, pull up the additional information. If someone says, I need to see the technical architecture, great, have it available, but have it as a backup and don't touch it unless they ask for it. Otherwise, go through the flow and make sure that you're reading what you're seeing from people. Are they not responding well to what you said about the market? Well, in that case, maybe you need to figure out a different way to address it. Don't be afraid in the middle of it to say, it looks like I missed you on that. Let me come back around, or how can I explain it? And hitting on a few of these, for us as venture capitalists, so we're looking for billion-dollar markets. And it has to be at least generally a billion-dollar market or larger to believe that a startup company can capture enough of it to be worth $100 million, $200, $300, $400 million or more, which it really has to be for the venture business. There are millions and millions of great businesses that will go after much smaller markets. Venture capital is probably not where you should go to get money. And there are options to go to seed financing, there get angel money, individuals, friends and family, but you do have to think through the amount of money you want to raise, what you're trying to build with your business, and what the long-term potential outcome for your company is. A pet peeve for me personally is when someone comes in and says, it's a $3 billion business and we need to capture 3% of it to be successful. That sounds really, really simple, but if it were that simple, a lot of other people would have gone and captured that 3% already. So understanding not just the size of the market, we're going to capture 1%, but here to Jeff's point, here's how I segment that market, here's how I think about going after the market, here's where I think I'm going to get my first set of customers and then build on that. On the competition and substitutes, there will absolutely be a startup competitor doing pretty much exactly what you're doing. It's a given. There are other people out there with the same ideas. That's not a bad thing. It's a bad thing if you're not familiar with at least a few of them and don't know that they're out there. If I can do a search on my phone and in 30 seconds find competitors to you that you weren't aware of, you haven't done enough market research. I think my bias, I think Jeff's as well, is that we rarely see our startup companies fail because some other startup company beat them to the punch. They fail because they don't execute, they didn't identify a market, or some big company is moved in a way that it's really hard to compete. Don't be afraid to acknowledge that, hey, this is a startup. We think what they're doing is pretty cool. It's pretty similar to what we're doing. Here's how we're different. And don't be afraid to borrow ideas from them when you start building the business. It's the absolute best way to succeed. And then on the analysis and thinking about the market segmentation, we were just talking about, we have a company in the virtual desktop space. And when we invested in this company, our view was, big enough market that this could be a couple $100 million size business. It could be a great company. But they had an additional solution that was focused on virtual servers that we believed once they came to market with it, made it a multi-billion-dollar opportunity if they executed. So to Jeff's point, there was a niche or smaller market, but still big enough that we thought this could get to over 100 million in revenue if they did well. But the potential there was significantly larger. They were smart to focus initially, and now they're starting to expand to the next market. So don't be afraid of having a smaller market, but make sure you can clearly explain, here's how we very easily move into these additional markets. It's not kind of a big leap of faith. It's kind of a natural transition into that next space.
All right. And then the business model, it's really, first part is around the unit economics, which is the CAC, customer acquisition cost, ASP, your average selling price, lifetime value of the customers. It's really kind of getting at those metrics, right? We're trying to understand what's it going to take to acquire a customer. What's going to be the lifetime value of those? How much are you getting in the first year? These things are really important because it eventually goes to what's the long-term viability of this, right? If it costs you $1,800 to acquire a customer and you only get $600 a year and they churn at 25% a year, we're going to keep building forever and we're never going to get anywhere, right? So it's really identifying what you think those are going to be, or if you know them, even better, right? If you have some empirical evidence, but what do you believe it's going to be? Why? What are the analogies you're drawing to get at those things? Are critically important to trying to understand, is this likely to be a successful business model or not? Equally important, and it really goes primarily to the customer acquisition cost element, is what is the go-to-market strategy? Are you going to have direct sales force yourself? Are they going to be inside sales? Is it going to be web-driven, channel-driven partners? And why are you choosing this particular channel? Is it successful today? Who's done it? Why do you believe that they're going to represent your product? Or if it's a direct sale, what are the costs that you're assuming? Again, what kind of analogies can you draw to get at your customer acquisition cost? Clearly the goals of financing should be here. You're trying to raise 2 million, 5 million, and why that amount, right? What are what are you trying to get to? You're trying to get to first product out, trying to get to 6 months worth of revenue. What are the milestones at which you'd go raise that next round and probably create a little bit of buffer for yourself because best laid plans. You're an entrepreneur because you're optimistic. Your plans are always optimistic. Trust me on that one. So you probably want a little bit more, but again, it's kind of, instead of just a random number like 5 million sounded good, like, try to really, think through how much does it take to build a team to get to a point where we've demonstrated some more value to where we could go, raise the next round, at a higher
And
risk.
generally on those early financings, you should think about milestones that are, what, 12 to 18-month milestones. So enough capital to get 12 to 18 months out, which is when you're going to go get the next proof points and try to raise additional money. Going much beyond that, the investors are going to look at and say, I'm giving you a lot of money up front, and 2 years is a long time from now. So setting those milestones up in sort of manageable bites is pretty important.
Yeah, so we like to set kind of 12 and 24-month models, right? So you do a 12-month model, here's my cash needs, and you're doing everything from the hires I'm going to make, when I'm going to make them, to the resources, the additional resources I need, whether it's consulting, legal, just laying out the framework or the financials from time 0 to month 24, and really understand what the capital needs are of the business, and that'll help figure out what you need for a dollar.
Yeah, and the key to that is that's the kind of backup level of detail that you should have ready to show, but it should culminate in the number and a quick explanation, because the next deep dive that Michael's going to do for us is going through that model and saying, walk me through who you're hiring, what the cost is. So work from there to get to that number.
And then we usually in there too like to see kind of a high-level 5-year financial plan. Kind of this is the trajectory of the business we think we're going to achieve. Here are a couple of the reasons why. And I just threw in some stuff around customer acquisition. But again, I apologize, it's probably kind of hard to read. But as you go from kind of the no-touch self-service all the way to field sales, right? Your customer acquisition cost goes up a lot, so you better be having a lot higher ASP as you go out there. That was just a
Jeff likes math.
yeah, exactly.
So one other question for you. So the other thing you might be saying is, well, I have this idea or this technology. How do I put this together, right? And what we tend to do is we tend to go out and we look at public companies and scour their financials. And
He means Michael does.
yeah, that's what I do. And really understand, how do they price their product? How do they sell their product? What's their business model? How do they go to market? Do they go to market through partners or VARs or resellers? Do they sell direct? Do they have inside sales force? Don't be afraid to go to their website, fill out the information, and have that inside sales guy call you and just talk to them. What do you guys do? How do you sell it? Do I get breaks if I have X number of people in my organization? And look at the competitors and look how they go to market, and kind of back up to the segmentation. Depending on what segment you want to sell into, you may have a different go-to-market strategy. So as you're putting the pitch together, you're trying to fill in the puzzle pieces. And there's, to Charles's point, the slides at the back of the deck are going to contain a lot of that kind of real detailed information, but you got to do that work to boil it up into this bigger pitch to get the attention in 60 minutes.
And just a few other points. Formal business plan, really unnecessary for the venture crowd. I mean, all of it, there's been all these PPMs always getting created. We don't read them. If you've got a good pitch, a short, good pitch, you got some quality financials and assumptions behind it, we'll be able to go all day and take care of things. So these, 50, 80-page documents, we see they get drafted and they have to spend a lot of money with the attorneys. Certainly don't do it for any venture capitalists. Maybe there's some set that likes those, but it's not the VCs. Product demo, that's pretty important. If you've got a good demo you can show that's really, easy, intuitive to understand, that's really valuable. There's nothing that really brings home what the product does, like actually, seeing you run through a demo of what a customer would experience, et cetera. That's, and again, make it short, make it pretty obvious. You don't have to go as far down the weeds as a customer might go, but really make it impactful. And that, like I said, is the demo's worth 1,000 pages. And then know your audience and tailor it accordingly. I mean, do a little bit of research on who the person is you're pitching ahead of time, what their background is. It'll let you know what you should be talking about, right? You see my background. You wouldn't come and pitch me on something really deep and just technical. I wouldn't know what you're talking about. So look at the backgrounds, see what you're going to do.
Yeah, and on a couple of things on that, and I'll go from the bottom top. So, getting meetings with a venture capitalist isn't an easy thing to do. If you send an email cold, the odds of it getting responded to are frankly pretty low, because a lot of stuff coming over the transom and you've got to siphon through to figure out who can manage it. So you're getting an intro, you've got a meeting set up, invest the time to really understand who am I going to be meeting with, or who might I be meeting with? What are the investments they've made? What are the interviews they've given? What are the articles they've written? You know, what is it that they're interested in? And so when someone comes in and meets with me and says, "Oh, I don't know anything about your firm, what do you guys do?" I'm kind of looking at them going, really, that's interesting, because I spent 30 minutes at least making a decision on whether or not to meet with you. And you came to meet with me and you didn't take the time to do some research and understand who I am, maybe through LinkedIn, how we're connected to each other and who we might know. Or the worst is when you sit down and say, okay, well, tell me everything about your background. And again, I'm happy to do it, but it's that, you know, we're taking time, we're spending an hour with you, we're meeting how many companies a week on average? Would you say you sit down? 8, 10, 12 in person? And we're doing this on a regular basis, having to spend of that hour. If you want, I'm happy to spend the whole time. I love to talk. I'll spend an hour telling you about myself, but the odds of us finding the business are 0. So come in prepared, know your audience, and understand what is it that they're more likely to be interested in, what are the things they're not going to be. On the business plan, I mean, honestly, I think the last time I funded a company that gave me a business plan was probably Newspeed, which is a good investment, but I never actually opened the business plan at Jeff's point. It's not necessary. Now, what is helpful to your company is having an internal plan. What is it, write up the strategy. It doesn't need to be the formalized plan, but you know, what's the thesis you're dealing with? What are the things that really drive the business? It's a living document that you use internally. You can always go back to and revise as you learn and you change, but that's not what the investors need to see. We want to hear the pitch. We want to meet you. We want to make sure that you're a valid person we should be listening to and we can believe in, and then we're going to want to do a lot of diligence on potential partners and customers and things like that. And the product demo, it is important. And what percentage of demos fail? Half?
Yeah,
they always fail. So you're going into a situation where you have to get onto someone else's Wi-Fi network. You know, problem number 1. You're going to be a little nervous. You've got a short period of time. You're probably feeling rushed. Problem number 2. And somewhere back in an office, someone is doing development work and may have just taken down your system without telling you to change code. Problem number 3. So really make it short, simple. If you can, we don't need to see the back end working. We can vet that during the diligence process. Make sure whatever you want to show us ties back to the opportunity you were referring to, doesn't get overly into the weeds, because we can do that later, but really highlights kind of what you're doing. It really just a critical thing that, and we always, it's never a knock if your demo fails, because
it's always funny when they say this never happens.
Yeah.
Well, it never crashes.
But it's amazing the percentage of time it happens, and it just shouldn't be that hard. I mean, you're running a tech company in our case, you should be able to give the demo. It's easier when, where's Dan, you know, when you can hand me your product, it's a much easier product demo to be able to do. We don't happen to be in the business of that. I mean, the companies we're funding need to log in and show us what they're up to.
And so now it's the Q&A. Really, it was a presentation. It's fairly short because that's, you know, how they should be. Again, there's, you know, really no magic in it. It's, you know, keeping them short, you know, hitting those, you know, key salient points, and that's, you know, that's really the foundations of a good pitch. But, you know, you got
can I say a couple things? So you put this pitch together, you get a meeting in front of a VC, you get through the pitch, and the end of it, don't be afraid to ask for feedback, right? Because the first VC you meet with might not be the guy who funds you. And secondarily, you're going to hear no. You're going to hear no a lot. And if you don't like to hear no, it's just part of the business. I mean, as a banker, I would work with early stage companies and go out and try and raise VC money on their behalf, and you're dialing for dollars, right? And by getting feedback, you're going to be able to tell the story better to the next guy. You're going to be able to articulate the pitch a little better on the phone to the next guy. You're going to increase the likelihood of getting a meeting with a new VC or a second meeting with somebody you just pitched. So use it, one, as a you know, a way to get your ideas out there, and 2, get feedback from the community and put that back into the presentation so you have more success as you move through time.
It's an interesting point. So if you, I'll stay up for now because we're doing Q&A. If you go and meet with 5 VCs and the presentation you give the 5th one is exactly the same as you gave the first one, you're not doing a good job listening and taking feedback. You're absolutely going to hear things from those meetings that make you think, oh yeah, I should present this in a different way. I should change this. We have one of our companies, a company called Coupa, just closed their Series F financing, or they're about to close their Series F financing. We invested several rounds ago, and he tells a story when he raised money from us originally. I think he had to meet with like 30 VCs. And there's a coffee shop on Sand Hill Road in Silicon Valley where a lot of the VCs are. And he would say that between every meeting, he was going back to the coffee shop. He'd have 20 minutes to change the things he knew he needed to change in the presentation, and then go try it on the next person. Learn from these meetings. I mean, take advantage of the opportunity and use that to pour it back into the business and the way you present the business. And I think you'll find that 5th presentation comes together a heck of a lot better than the first one you gave, for obvious reasons.
And if nothing else, it's cathartic.